Welcome to Pro News Weekly. Let's dive into the latest updates on the financial markets. The dollar cannot be underestimated, stock indices are consolidating, the gold bubble has burst, and Bitcoin is longing for the old days. A reassessment of the fate of the federal funds rate and the weakness of its main competitors has allowed the US dollar to rise. Since the Fed resumed its monetary easing cycle in September, the dollar index has increased by 3%. The greenback was helped by the budget deadlock in France, the change of prime minister in Japan, and concerns about the British government's ability to plug budget holes. Investors are dumping the euro, yen, and pound because of these policies. Markets have priced in 5 rate cuts in 2025 to 2026. The FOMC forecasts only 3. At the same time, fears that the Fed will be proven right force investors to return to the US dollar. The acceleration of US inflation in September is unlikely to dissuade the central bank from cutting rates in October and December. However, it may then take a long pause. This supports the US currency. The US dollar is not falling due to the second longest shutdown in history and the escalation of the trade conflict between Washington and Beijing. Investors believe that the US government will resume work sooner or later, and that the United States and China will find common ground. October is living up to its status as the most volatile month of the year for the S&P 500. The broad stock index recovered and stumbled again after the most severe sell-off since Liberation Day. Expectations of further policy easing and upbeat corporate earnings are playing into the hands of the bulls. 85% of companies that have published their reports have exceeded forecasts. This high figure indicates their resilience in the face of tariff threats and political uncertainty. According to JP Morgan, S&P 500 issuers will see 12% profit growth in the third quarter. This is significantly higher than the consensus forecast of Wall Street experts at 7.7%. The stock market has ignored the negative for too long and has only heard good news. Now investors are revising their views. Against growing trade uncertainty, they are in no hurry to buy up failures. According to research by Goldman Sachs, purchases of the S&P 500 after the pullback are from sellers closing short positions. If so, the stock market will continue to consolidate. Gold has fallen victim to the most spectacular sell-off in 12 years. In dollar terms, Monday's intraday drop of $230 per ounce was the worst in history. Bespoke Investment Group notes that in the 21st century, there have been only 6 instances when the precious metal fell by 3% or more in a single day. And in the following month, it lost an average of 18%. Investors are racking their brains over the reasons for the collapse in gold. Is this dynamic the result of de-escalating the trade conflict between the US and China? Or is it the result of the strengthening of the US dollar? Perhaps Donald Trump has managed to drive a wedge between Russia and India, and the bipolar world will collapse. There are even conspiracy theories about this. They say that at the IMF meeting, the powers that be decided that gold had climbed too high, and it's time to stop the bulls. What next? If the trend has indeed reversed, now is the time to start selling on the rise. However, gold bugs believe that nothing has changed. The bet on currency depreciation remains in force. The colossal US debt has not disappeared. Central banks' appetite for bullion is high, and the Fed will continue to cut rates. Should we buy the dip? Or look for alternatives, for example, in platinum, whose quotes are recovering quickly. The rapid growth of Bitcoin against the backdrop of the collapse of precious metals proves that one of the reasons for Bitcoin's negative dynamics in October was its lag behind gold. Those who considered cryptocurrency a reliable asset due to its limited nature and decentralization were mistaken. Tokens remain a risky instrument, albeit less risky than before. Legislative changes allow crypto whales to transfer their money from wallets to ETFs. BlackRock notes that its clients are ready to shift 20% to 100% of their digital assets to exchange-traded funds. Traditional finance has many advantages, including collateral. However, the more institutional investors it has, the less volatility it faces. We should not expect such turbulent movements in Bitcoin as we have seen in previous years. According to Deribit Coinbase Global, Bitcoin contracts with a strike price of 100,000 are the most actively traded on the derivatives market. This is how traders protect themselves from the risks of a further decline. In the last week of October, investors will be focused on US-China trade negotiations and news surrounding Donald Trump's visit to Asia. The main event on the economic calendar will be the Fed meeting. The futures market gives a 97% probability of a cut in the federal funds rate. The chances of another cut in December are estimated at 93%. The Fed is ready to continue despite a lack of data due to the shutdown. However, accelerating inflation could increase the number of hawks. In addition, monetary conditions are very relaxed, and the leading indicator from the Atlanta Fed signals an acceleration of the economy to 3.9% in the third quarter. Is it worth lowering the rate in such conditions? If Jerome Powell signals a slowdown in the rate-cutting cycle, the dollar may strengthen and stock indices may fall. This will undoubtedly anger Donald Trump, but the Fed must not allow a repeat of the 1970s. Back then, rampant inflation forced a return to aggressive monetary tightening, which led to a double-dip recession. Follow the latest developments on global markets in Pro News Weekly. Like, share, and subscribe.